The stock market has crashed over the past few weeks. Officially, the NASDAQ is in bear market territory, meaning it's down over 20% from its highs earlier this year. S&P 500 isn't quite there as I'm recording, but this is now a time that investors who are long-term investors who are looking for businesses who are going to be much bigger and stronger 10, 20 years from now need to start looking for opportunities. And so there are 4 stocks that are down over 50% that I think are really compelling opportunities. I own a couple of them in the asymmetric portfolio. So I want to dig through those 4 today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, FinChat. FinChat is a complete stock research platform for long-term fundamental investors. It's a product I use every day. And here on Asymmetric Investing, all the charts that you see, those are all coming from FinChat because it's so easy to find information from the income statement, balance sheet, statement of cash flows. But they also have these phenomenal KPIs or key performance indicators that'll really give you an idea what's going on under the hood at a company. If you want to look at transcripts or if insiders are buying, selling stock, all of that is also very easy to find on FinChat. So you can get 2 weeks of FinChat Pro, which is what I'm going to be using here on this video for free. And you can get that at finchat.io/ASYM. If you like what you see, and I think you're going to get 15% off after that. So a phenomenal deal they're offering from FinChat, just one of those platforms that keeps it getting better day by day. But let's go through those 4 stocks that I really like right now. Let's start with Coinbase. Coinbase is one of the companies in the asymmetric portfolio. I'll put a link below to the spotlight article I did on Coinbase. I was buying shares of Coinbase in mid 2023. So you can see that the stock, let's go to the stock price here. You can see that shares are trading at $50, $60 per share at that point in time. Obviously, shares got up to over $300 per share. The business has gotten a lot better since then, but the drawdown, and this is just the change in the stock since its peak, just this year is 47.7%. So that is a huge pullback in the stock, but there's a lot to like about Coinbase. The crypto market may be getting hit a little bit, but I don't think this kind of pullback is really deserved from a company that's leading in the blockchain. Look at this $40 billion market cap that you can see here. The other thing to look at with Coinbase is their balance sheet. They have a ton of cash and equivalents on their balance sheet. They do have some debt, but they have the flexibility to buy back stock if they would like. They can pay down some of that debt if they would like. And the cash continues to come in. The one thing that I want to highlight here, and this is using these KPIs on FinChat, but you can look here at total transaction revenue for Coinbase. You can see that that more than doubled between 2023 and 2024. But what I'm more concerned about is things like stablecoin revenue, blockchain rewards, interest and finance income, custodial fees, and other subscription and services revenues. These are the non-trading revenue sources for Coinbase. This is going to be them making money on being a leader in the blockchain. So things like the USDC token, that's the blue column right here. Most of that revenue is going to be coming from the USDC token, nearly $1 billion in revenue over the past year in 2024, and that momentum is going to continue. This is the market cap of the USDC token. You can see that a year ago, the market cap was about $32 billion. Now it's over $60 billion. The assets behind the USDC token are going to be invested in things like treasuries and savings accounts. They're going to generate interest revenue. That interest revenue then ultimately flows to Coinbase in the form of stablecoin revenue. So if that market cap for the USDC token continues to grow, this number will continue to grow for Coinbase. That is going to be a positive tailwind for them. On top of that, they do have a position in Circle, the company that actually runs the USDC token now. So that's another thing that's not really hitting the balance sheet right now. We don't know how much Circle is exactly worth, but I wouldn't be surprised if that's one of the companies that goes public over the next year or two. The other thing, blockchain rewards. So this is going to be things from staking and things like that. Custodial fees. You may know that Coinbase is the custodian for most of the crypto ETFs that are out there. So $142 billion in revenue and growing. All of these sources of revenue are growing now, $2.3 billion in revenue over the past year. And with compound annual growth rates that are in some cases over 100% over the past few years, I think this is going to continue to be a tailwind behind Coinbase. Now remember, these numbers do not even include any of their trading revenue. You bring in that transaction revenue, you can see that 2024 was not quite as good as 2021 was. Not a lot of years are probably going to do that in the future, but almost $4 billion worth of revenue. So still a great business for Coinbase. And the valuation is just too good to pass up right now. Price to earnings multiple on a trailing basis, 16.9. Even on a forward basis is 20.1. Now, analysts, I think, could potentially be underestimating the profitability of this company. because there is so much non-trading revenue that continues to come in. But I think the tailwinds behind Coinbase are going to be enduring. This is a company that's trying to update the financial system by making things more efficient on the blockchain. The base blockchain is doing that. USDC token is doing that. All of the infrastructure that they're building. I think the tailwinds behind Coinbase are going to last decades. And so $40 billion market cap that we're getting it at today, the flexibility that management has with over $8 billion worth of cash on the balance sheet, this is going to be one of those stocks that I think we're going to look back in a few years and see this as a phenomenal buying opportunity, just like the down market just like the crypto winter in 2023 was. We're going to say the same thing about 2025. So one that I've added recently, again, to the asymmetric portfolio, haven't bought for a little while, but one of the top performing stocks, if you want to check that out in the asymmetric portfolio. The second stock today, Deckers Outdoor, ticker symbol DECK, $16 billion market cap. You can see the price earnings multiple is now down to 17.3, forward basis 16.5. This, I wouldn't be surprised if that changes, because Deckers' price structure and the impact of tariffs is going to be potentially pretty high on Deckers Outdoor, but we don't know exactly how that's going to end up over the next, let's say, 6 to 9 months. That's really why the stock is sold off. You can see the drawdown in the stock, 53%, and that's just since kind of middle to the end of January. That was when the stock peaked. So stock is just plummeting, but you can see the valuation is much, much better. But let's look at the at least trailing financials. We don't know the full impact of tariffs right now, but you can see that this is a company that has grown steadily and has solid net income. We'll just look since 2019, compound annual growth rate, 16.7%. Net income has grown at a compound rate of 25%. You can also look at the growth of their two most important brands. That's the UGG brand, kind of in this dark colored column here. Not a ton of growth from UGGs. The total change is 42%, compound annual growth is 6.3%. So I think this is a steady as it goes brand, not necessarily a huge growth brand. The growth for Deckers Outdoor is going to be from the Hoka brand. Compound annual growth rate is 41% over the past 6 years. So again, the market has thrown a company like this, I think, out with the bathwater because of the impact that could be coming from tariffs. Now, that isn't to say that tariffs isn't going to be potentially a big headwind in the US. That is going to increase costs. But who are the people who are going to be buying Hoka shoes? It's not going to be a discount shoe. It's a pretty high-end shoe. So that shoe going from, let's say, $120 to $150 or $160, when everything else in the consumer space is going to be going up by 30, 40, 50%. I don't think that's going to be too jarring for consumers, and the kind of people that are going to be buying Hoka shoes are going to continue doing that. So they're going to be able to pass a lot of those price increases on to the consumer. Just going to be the reality in the consumer discretionary business right now and in the fashion business. But I think Deckers Outdoor, the valuation is just too good to pass up right now, just like we see with Coinbase. I do think there's a lot of growth. There's uncertainty though, and that's why you're getting the deal and the price that you are today is that uncertainty that we see in the market. But long term, I don't see a lot of competition coming for Deckers Outdoor, and they do have agency here. They will be able to adapt to tariffs, whatever they look like in the future in the US. So I think a solid buying opportunity for some of these big consumer goods, fashion brands that have a durable competitive advantage and brand that they're building. Don't want to be in that discount space, but if you have a good brand and you're serving more high-end consumers, I think those businesses are going to be fine. Number 3 is Celsius. Celsius has plunged over the past year or so. Let's look at the drawdown in Celsius stock. You can see that this is at 62.8%, hit about 80% from its peak in early 2024. But now again, the valuation is looking much more compelling. These numbers don't include the addition of Alani Nu, which the company recently acquired. Price earnings multiple, though, on a forward basis is about 37, trailing basis is about 78, and that enterprise value to sales multiple is 6.1. Now again, you can see this long-term revenue growth. 2024 was a little bit slower, but this also doesn't include that addition of Alani Nu, which they bought for a little bit lower than Celsius stock is actually trading for right now. That should be a nice tailwind on their performance. I think we've also seen kind of the clearing event with the inventory changes in Pepsi, their main distributor. So that headwind should be behind us. And throughout 2025 and 2026, I think that we're going to see steady growth from Celsius. And then also the addition of Alani Nu should get them into more new markets. The real opportunity for Celsius is going to be leveraging kind of the certainty that they have in the business to see those margins go up. I changed this to trailing 12-month numbers, where you can see the headwinds that happened kind of later in the year in 2024. Those operating margins went from 22% down to 11.5%. So that's why profitability suffered in later 2024. We should see that start to normalize in 2025. So I think the results are going to be solid going through this year and then into next year as Alani Nu is integrated into the company. The fourth and final stock is one that continues to be hotly debated. You can see the massive spike in shares earlier this year got to about $70 per share, but the drawdown, and I'll pull this back to just the past year, about 60% as I'm recording right now. So Hims and Hers trading for $27.87 as I'm recording. But keep in mind, shares are still up 87% over the past year. And the price for the stock is pretty compelling. Enterprise value to sales, this is for a company that grew revenue at over 90% last quarter. 3.7 times sales. You're not going to see a lot of companies trading for that multiple and growing that quickly. Now, there's a lot of questions about what happens with GLP-1s, but that is a product within a number of products on the Hims and Hers platform. So there's a lot of focus specifically on GLP-1s. Yes, that's going to hurt the company's growth rate. But if you go from a 95% growth rate to a 40% growth rate or even a 30% growth rate, you still get a great company and I think a great value at 3.7 times sales. But there's going to be volatility. That is what we know with Hims and Hers. But the reason that I think this is a compelling price to pay today is you get a much better company than you did a year ago. They've now moved into more markets. Menopause is going to be coming later this year. They bought a couple of companies that's going to bring at-home testing, peptides to the business. So the platform continues to grow. And as it does, revenue grows and operating income has started to see some leverage as well. Here's the thing that management said on the last conference call. They're going to expect 1 to 3% improvement in their operating income over the next few years. So we're just barely getting to, I'll pull this operating margin line up. You can see that has steadily improved over the past couple of years. These are now trailing 12-month numbers, but 4.5%. So they're basically saying that 3 or 4 years from now, they're going to be at 10% plus operating income margin. They're able to grow the revenue even 30, 40% and improve their margins from 4.5% over the past year to over 10%. That is going to be a phenomenal business and a phenomenal returning stock. Getting it at under $30 per share is going to look like a steal in the future because of this short-term dislocation in the market. So Hims and Hers continues to be one of the stocks that I am most bullish on long-term, but you got to ride out that volatility. Volatility is the price that we pay to get great investments long-term. But I think this company is still hitting on all cylinders and still very misunderstood by the market. So there are the 4 stocks that I think investors should be looking at that are down over 50% from their highs: Coinbase, Deckers Outdoor, Celsius, and Hims and Hers. Let me know what you think about those 4 in the comment section below. Of course, check out FinChat. Go to finchat.io/ASYM. I showed you a lot of the tools here, but there's even more. Everything from investor relations, analyst estimates. They've even got their own modeling tool built in there. You can just go change growth rates, margin rates, the discount rate you want to look at, and just get a quick look at what you think the valuation of a stock should be. Is it overvalued or undervalued based on today's price? Just phenomenal tool. So check that out at finchat.io/ASYM. And of course, check out my Asymmetric Investing newsletter. I think you're going to get a lot of value there. Thanks for watching, everybody. See you here next time.